introduction would be Jackson being the director of Aotearoa New Zealand Stewardship Code, the framework for investors used to influence and steer the companies for critical environmental, social, and corporate governance issues. In terms of background, Jackson's completed a graduate study as an Obama Scholar at the Columbia University in the city of New York. He studied sustainable finance and he's been a director of Akina Invest at the Akina Foundation. So today, just in terms of format, Jackson's going to run through the stewardship code, some of the influences that sort of brought it together and where it's going in future. We'll open up to Q&A fairly quickly. We want to hear what you guys have to say and we can have a chat about that. So put your questions in the chat, otherwise we might be able to put the spotlight on you and form part of that discussion. But for now, I'll jump over to Jackson. Thank you.
Thank you very much, David, and kia ora koutou, everyone. Thanks for joining the session today, and thanks to CFA for inviting me along. I am just going to try and share my screen so you can hopefully see some slides. David, can you see them all right?
Yep, no, it's looking good. Thank you.
Excellent. So this is just going to be a really quick introduction, I guess, to the Aotearoa New Zealand Stewardship Code and a bit of a look as to what's happening both with the code in New Zealand, but also globally, because stewardship as a practice across investment management has really been continuing to accelerate pretty quickly globally. So just as a kind of a broader, bigger picture introduction initially, when we're talking about stewardship, we're talking about stewardship creating and preserving long-term value for current and future generations by responsibly managing and allocating capital. So ultimately, it's about how do investors use the influence and the tools you have to support the companies that you own to maximize that long-term value. The stewardship codes, when we're talking about codes, they give investors a really clear framework around how to do that. So typically, globally, they'll set out principles of the key activities investors should be doing to really maximize that long-term value for the companies that you own. What a lot of people don't realize is that stewardship codes are really prevalent around the world. So there are more than 20 different codes around the world at the moment. The UK code is often seen as the leader in this space. It was created in 2010, actually off the back of a review following the GFC, where they were looking to increase trust and better risk management across the financial sector following what happened in the GFC. And the code, amongst some other things, was identified as a really important lever to do just that and really start to rebuild trust in the financial sector. I think that kind of big picture piece, if you like, around the reason stewardship codes exist and the prevalence of them internationally is actually really topical right now with the risks and the status of the world, if you like, and some of the geopolitical risks and the changings that we're seeing. I think a framework that was designed to support risk management and maximize trust of the financial sector is really important today as it has been previously. So the New Zealand Code, the New Zealand Code was launched back in 2022 off the back of a Sustainable Finance Roadmap initiative led by the Centre for Sustainable Finance. It was one of a number of recommendations to support New Zealand's financial system to become a more sustainable financial system in the longer term. And it came about for a few different reasons. One was the fact that at the time, the leading responsible investment activity in New Zealand was negative screening, and that was a bit out of step with the rest of the world, which had largely transitioned to stewardship and engagement as the more common and effective responsible investment strategy. The other thing that we were hearing, though, is that there was, of all the influences that companies were facing and having to navigate around, or the support they were receiving to navigate risks and opportunities, shareholders typically weren't in the picture. It was legislation, it was directors, it was a number of different factors that were influencing companies to navigate longer term risks and opportunities, and shareholders weren't really there. So those were just a couple of the key reasons that the Stewardship Code recommendation to develop came about, and it was created through about 18 months of industry collaboration back in 2022, and that led to the code launching late that year. As you can see on the left on the slide there's a very high level summary of the principles within the code. So a lot of this isn't rocket science, if you like, for when it comes to good investment management practice, but it is still really important foundations and fundamentals that at times don't happen often enough into the level that they could. So, for example, it's about establishing and maintaining stewardship policies and incorporating material ESG matters. And then the row of four icons there are kind of the core things we often think about when we're talking about stewardship. So that is one, engaging with companies. So how are you meeting with and supporting the companies that you own to influence those longer term opportunities? Voting responsibly. This is one of the things that, I've had stakeholders in the ecosystem tell me that before the stewardship code, they didn't really vote consistently on the proxies that they and their AGMs that they had for their companies. And so it's really important, as a part of the role of being an effective investment manager is to make sure you are exercising your rights to vote and doing so really thoroughly. So that voting piece is an important part of stewardship. Managing conflicts of interest, collaborating is a really growing one in New Zealand, and it's a really important one, I think, to properly utilize the weight of different investment managers and the assets that you bring, and increase that collaboration, and in doing so, reduce the burden on companies because you can have one group going to engage with that company rather than multiple different engagements separately. But that's just a snapshot of the principles that sit behind the code. I should also note that because the code is specifically developed, within New Zealand for New Zealand, it leans heavily on international codes like the UK code, but we've really thought about what makes it right and relevant to New Zealand. And an important part of that is the Te Ao Māori piece. And so we do encourage signatories of the code to consider Te Ao Māori perspectives within their investment practices and think about how it can support them to maximize that long-term value of the portfolio. So that's just one example where we do bring in specific New Zealand references to the code. And then on the right there, you can see the signatories that we currently have to the code, and we're always welcoming new signatories. And we really quickly had majority of the assets under management in New Zealand sign up to the code. And so you can see there we currently have 23 signatories across asset owners, managers, and service providers as of this year as well. And we were launched, if you like, through the Centre for Sustainable Finance Roadmap Initiative, and we continue to be hosted by both the Centre and RIA to really maximise that alignment and coordination across New Zealand's sustainable finance ecosystem. So this slide's just a few really brief kind of updates around what's happening in New Zealand and in terms of stewardship. So first, I touched on that rapid adoption piece already. We've got 23 signatories. Collectively, they manage majority of the assets under management in New Zealand. And I'd also note that about a quarter of the signatories are actually international managers. So we've got a couple of the largest global managers, the likes of Northern Trust and Nico Asset Management, Russell, and some others who want to demonstrate their leadership and stewardship and often sign up to multiple codes around the world to really demonstrate that leadership. Behavior change has been a really great outcome of the code, and the code isn't just an academic exercise, if you like. It was really created because of that need to transition the way that investment management is done in New Zealand. And now, following the code's introduction in 2023 in RIA's benchmark survey, they found that stewardship was the most common responsible investment strategy, overtaking that negative screens as the most common approach, which is really great for New Zealand and aligns us better with globally leading practices. Capability uplift is another key thing we're seeing, and so as the code as an organisation, we hold regular events and forums for signatories to learn from each other and to build that stewardship practice. And so often, this morning actually there was a call for signatories where we had guests from Nico Asset Management come along and share some of their practices around stewardship across, their global organization that has more than 50 years experience. So we're often bringing in international experts to really support and lift practices within New Zealand. And then disclosures is another big thing. So last year we received 16 stewardship reports, which is a really big uplift in the nature of disclosure around stewardship and also, the transparency and accountability that creates. A couple of themes that come out from those reports. One is firstly really strong alignment with the codes. We're really pleased to see that. Well, there was a bit of a difference in the rating or in the rates of votes against shareholder resolutions from New Zealand signatories in comparison to international signatories. So you can see that international signatories on average voted against resolutions 15% of the time, while New Zealand signatories voted against 8% of the time. So that's the difference there, which we found quite interesting, and it'll be interesting to monitor how that changes over time. We also saw that 100% of signatories were willing to collaborate with other investors, and particularly when we hear of the challenges of collaboration. And because of antitrust rules in the US, for example, we're really pleased to see that in New Zealand there's still a really strong willingness to collaborate. We did notice, though, that there was a greater disclosure of examples of collaboration in international markets than in New Zealand. So often, the signatories may be participants to Climate Action 100 plus, for example, and therefore being part of an engagement group with a large global business. And that means that there's limited engagements with New Zealand companies specifically. And so that's something we're looking to change going forward and really increase that domestic focus of engagements. And finally, the strongest disclosure areas were around voting, which was one example of pretty strong disclosures. And conflicts of interest is an area where we're looking to improve the nature of those disclosures. And you can just see at the bottom there, the great governance committee members that we have to support the implementation and oversight of the code. Um, this slide's just a couple of brief examples to bring this to life for those of you that are less familiar with stewardship. One, many of you may have heard after the horrible Christchurch terror attacks a number of years ago, the New Zealand Super Fund led a collaborative engagement with over 100 different fund managers from around the world to influence social media companies to adjust their processes around the extreme content that was able to be seen. And this led to changes by Facebook's Audit and Risk Committee in this instance to prevent objectionable material. So that was a really great example of investors using their influence to support these companies to get better. Bondholder engagement is something that we're increasingly starting to talk about in New Zealand, and it's not just about equities, but actually other asset classes. How can they be supported to manage these long-term risks and opportunities? And there's an example here with Aviva investors highlighting the positive outcomes that arose after engaging with Barclays Bank on some of the lending that they're doing to fossil fuel projects around the world. I'll be happy to circulate these slides afterwards, and there's links in these headings for more details. And then just briefly on the global updates. So one, I guess the key message here is that stewardship generally continues to rise really strongly around the world. Most recently, in the past month or so, China has actually released a new stewardship code. The UK code also recently underwent a fundamental review to further strengthen it. The key changes there were aimed at reducing the reporting burden, which had become quite major in the UK. The Japanese code has also been reviewed recently, where they aim to streamline it again, managing that burden, while also increasing collaborative engagement. And that's, again, a theme that we see in much of the world is the goal of collaborative engagement actually increasing rather than decreasing. The US, I'm sure we've all seen the headlines here, so I won't labor on the US too much, but I've just called out a couple of examples here which kind of go against a number of the headlines that we see. One, I was over in the US a couple of weeks ago for a conference in New York, and the New York City comptroller actually said, if we don't do systemic stewardship, we lose billions of dollars in value. And so I thought that was a really good example where, yes, there's headlines, yes, there's geopolitical issues and things, but at its core, when we're looking at influencing the long-term risks and opportunities that companies face, that continues to be important. And there's a number of people in the US who continue to see that and continue to practice that. CalSTRS, one
Just
of the
thinking, Jackson, do you think that's a good segue into like the discussion between, obviously we've seen the backlash with some of the ESG, the headlines and some of the asset management companies managing the assets in the US at the moment, but how that works for where ESG integration sits and where active engagement and stewardship sits sort of in that spectrum?
Yes, it's definitely. So it was really interesting. I mean, I would need to caveat what I say here in that I was in New York a couple of weeks ago. And New York is a bit of a bubble, if you like, amongst, and different in some respects to all of America. But certainly, what the real theme in the room there, and what I've heard through my various conversations, is that stewardship as a strategy is still generally widely accepted in the US and widely practiced. What isn't as regularly communicated, at least, is the really clear ESG connection that we in New Zealand openly talk about with stewardship, and that we know we need to manage E&S risks and opportunities to support that long-term value. In the US, they won't talk about that as openly as we might here, but they know that actually, climate change, for example, is a risk that is affecting the long-term value of their portfolios, and so they're still working through ways to manage that. They've just kind of separated, I feel like, the ESG part of stewardship, and it's more about how do we influence companies and what are the key risks there, and talking less about ESG. One final note I'd say on the US is that a real big thing that I took away a couple of weeks ago was that capacity generally, actually, I've touched on this in the next bullet there, capacity generally is often a challenge for stewardship, particularly in New Zealand where we're smaller managers, more limited resourcing, etc. But what we're seeing in the US is it's capacity is part of the issue, but actually increasingly it's about conviction in the US, and how much do you believe as a firm that there are long-term risks and opportunities that you should actively be influencing. And the key message from a number of managers over there is that we need this conviction. We need to still be influencing the broader system here, because that's what's important for our returns in the long term. So that conviction piece was really important.
How do you get the right balance, I guess? Because you've got, the UK code arguably getting bigger and bigger each year, and, some saying it's become quite a compliance burden. They're obviously leading the way in a lot of matters, but if we copy a lot of what that was going on there, then we're going to be placing quite a compliance burden on New Zealand when we're not really at a size and scale to sort of have dedicated departments doing this sort of thing. It sort of falls on existing staff to do the work. So how have you found getting the right balance with that sort of thing, or feedback from people?
Yeah. Yeah. So we work really closely with the Financial Reporting Council in the UK. And so we've had a number of conversations with them. And even they would quite openly say, I think, that the 80 to 100 page reports that are really normal for the UK code are just not what they ever expected or wanted or think is success, right? And so they've just, the review they've done recently, a specific aim of that was to reduce that burden. I think the CEO of the FRC was actually quoted saying they're taking an axe to the reporting aspects of the code. So they're really doing what they can to reduce it. But at the same time, given that feedback and given exactly your points, David, when we launched the New Zealand code, we've really tried to front foot this and said right from the start that success for us is not a 100-page report at all. We would encourage, 10 to 12 pages that really summarize the key relevant information that you should be communicating for your stakeholders to understand around your stewardship activity, and just keep it really short and concise. Because, we do think this accountability and transparency around what is a really important part of being an effective investment manager is important to communicate, but that's not communicating it to the detail that some international managers will provide. So that's kind of how we're trying to strike the balance, is right from the outset saying reporting only really needs to be 10 pages, but we do think reporting is important to communicate some of the key things that many of your stakeholders will be wanting to know about how you're managing their assets.
It's hard to get the right balance between like understanding, like letting people make them fully informed and being transparent, and sort of that length of the report. I've been guilty
Yeah.
of a few 100-page reports coming out of Russell Investments, and the first question, people are impressed, and then where's the executive summary, and then followed by feeding it into AI to sort of make sure they can get something out of it because it's just too much.
Yeah. Yeah, no, I've had the privilege of reading many of those reports as well, and they are,
Yes, I bet.
valuable and interesting documents. But it's about, what is right for your stakeholders, and for a large global, there are lots of different stakeholders, but hopefully we can influence that in New Zealand. I'll just quickly, I think I just have, you can probably read the rest of the slide. Resourcing is always, as I touched on, is always going to be a challenge. But I think it's interesting to note there that PRI's increasing focus on sovereign engagements, particularly at the moment across Australia, Japan, and Canada, but they are considering whether New Zealand should be a focus for future sovereign engagements. So that's just interesting perspective of how investors can actually influence government and sovereign entities around the bonds and things that they may be issuing. Final slide here. So just kind of looking forward. So for the code, our real priority is embedding stewardship across New Zealand through regulatory alignment, more signatories, lifting stewardship practices, etc. So stewardship itself, I wanted to kind of to the US conversation and to front foot this. There is some conversations around whether stewardship and whether investors are appropriate to influence companies. I think those conversations it's the classic kind of small but loud thing. I don't really see from all the practice I look at globally, I don't see a large shift away from stewardship. And I've repeated the controller's quote here: if we don't do systemic stewardship, we lose billions of dollars in value. So while there's certainly some people that would prefer to see investors not using their influence, I think that's a very small minority and just belies logic really in terms of the fiduciary duties that we have. So I very much see that going forward. Increasingly systemic, I think investors are increasingly recognizing that some of the risks that are affecting portfolios, whether it's social inequality or climate change or some of these longer term risks, are increasingly connected and systemic. And so we need to start thinking differently around how we influence those risks. Working on we are working on some guidance around Te Ao Māori perspectives and how they can be better incorporated into investment. I mentioned stewardship across different asset classes. There's a link there to a webinar that we've done recently because I think that will be a growing priority in New Zealand, and really trying to push those domestic collaborative engagements and also sovereign engagements in New Zealand. And then maybe I'll pass to David to do that segue to the CFA members, but we certainly welcome new signatories from any of you all. And I'd also emphasise that if any of you are at companies right now, or corporations rather than asset managers or owners, hopefully there'll be increasing opportunities for engagements from investors with you as well. And we just really encourage you to welcome those engagements, prepare for them, and ultimately to find that compromise and value in the middle to support both sides, because that's the aim of these, is to maximize that long-term value, which is presumably the aim of the company as well. So hopefully that's been a really quick introduction to the code, David.
Yeah, cool. Thanks very much, Jackson. Yeah, just on for CFA members, we often get people asking, what can I do? And sometimes they're at a more junior position, sometimes they're at a more senior position. A lot of the time, you can obviously make people aware that the code is, there's various codes around the world. There are options in terms of, becoming signatories. I can obviously talk to Jackson about that. But even just obviously, you can see, and that's why we try to separate out the ESG. I guess the backlash in the US is actually quite separate from active engagement and stewardship. Active engagement and stewardship is more a tool in terms of enhancing shareholder outcomes, whereas you could argue ESG is more a thematic thing. So there's always going to be active engagement, and stewardship codes are definitely here to stay. So what we would want to draw attention to is, the CFA Institute got a lot of resources in this area on the quite a few areas. So the CFA UK do an impact certificate that deals quite a lot with stewardship. It's also involved in CFA Institute's climate valuation. I've got a course on that as well. And there's also the sustainable investing certificate. So that covers both ESG and active engagement. So there's a lot of options there in terms of upskilling yourself and making sure, there's interest in the space, making sure you've got the right skills and can sort of talk the talk. In terms of, we can open up for questions if you like. Let me just see, Helen, if we've got anything there. I'll just, maybe while they're coming in, I'll just start with a couple myself. So we did talk before on the UK kind of being the mothership for a lot of things. And yeah, bigger markets, more resources. It's obviously been frequently updated, and I see that, it's good to see the New Zealand code also sort of expanding in reach. Can you talk to us, Jackson, about any plans that there are for review of the New Zealand code, particularly around, areas of strategic focus in the future?
Yeah, absolutely. So we last reviewed, the code was launched in late 2022 and it was reviewed last year for the first time. that was a really high level review because being a relatively new framework, we didn't want to be too disruptive with how it's being adopted and applied across the market. So it was really just to check for any kind of implementation red flags. And there weren't any, which was really great. So we didn't change the substance of the framework for asset managers or owners. What we did do is extend the code to service providers. So to your point around furthering the reach, the code is now applies to service providers. So that could be asset consultants, data providers, those who are working there in the investment management value chain. Really welcome them to be signatories to the code to maximize that alignment and ultimately the effectiveness of stewardship activities too. Our next review of the code is earmarked for 2026, and so we're expecting late next year to do a review of the code. We do prioritize alignment with international codes, and that includes the UK code, obviously. And so one of the bigger changes they've done in the review of their code this year is actually separate some of the reporting expectations. So there is now, they expect an annual activities report that summarizes the key things that engagements and voting and the things that you've done and that change each year. But then there's the more kind of fundamental policy piece that is they require being reported every 3 or 4 years now, and so that will be reported less often for the dual signatories that we have that are New Zealand and UK signatories, for example. So that bifurcation is something that we'll be considering as part of the review next year, just to make sure that we continue being in alignment and supporting that interoperability between codes, for example. But certainly currently there's no kind of major red flags or anything that we see that needs to change for the New Zealand market. We'll really be thinking about, is the code at the right level to continue pushing the standard and pushing stewardship to make sure that New Zealand is keeping pace with international stewardship expectations.
And in terms of like all the codes, or maybe just the New Zealand one, how do we evolve from just sort of having kind of activity-based metrics showing progress in terms of like, look how busy I am, towards
Mhm.
actually showing engagement outcomes? Like, is there a way that it can actually be measured, or are we sort of just hoping there's a correlation between activity and outcome?
Yeah, so there's a bit of all of the above. Certainly something we have a couple of master classes and things like that signatories join that hopefully start to answer this question. And some of the things we talk about, for example, is the fact that I think when stewardship started, there was this activities oriented reporting, if you like, and often you'd see in reports that a manager may have sent 1,000 letters to chairs of companies, for example, and that is the metric that they're reporting as a sign of their engagement. But something we're really regularly saying to signatories is that it has very little meaning, and it doesn't really indicate how you're influencing risks and opportunities, which is the goal of stewardship. So actually, to your point, we're encouraging signatories to take more of an outcomes-oriented approach to the reporting. Talk about what are the risks and opportunities that you're trying to influence, talk about how you're doing that, and talk about what you see change. Now, often, as many of you will know, these changes take many years, right? It's often a long conversation with companies to help them adjust what they may be doing. But we really encourage disclosing those observations and what you are seeing change, whether it's internal within your organization, so outcomes of the work internally, but also certainly with the companies that you're engaging with and what changes are you seeing. A connection which has often been a challenge in the industry and something we're starting to see some change around is whether you can kind of claim attribution. So can you say that you caused the change? Increasingly, that's getting harder and harder, right? And I think that's part of the reason that this whole kind of outcomes oriented reporting it is difficult, because organizations try and say they caused the change or attribute the change to their activities, when actually while risks are getting increasingly systemic and interconnected and collaboration is increasingly common, that ability to be able to claim attribution or causation to this sort of these risk management is really difficult. And so we and many internationally are also encouraging investors just to be comfortable with that and to not require attributing or saying the change happened because of my work. The change happening is what's important, and that's what's managing your risks and supporting your outcomes and benefiting your beneficiaries, etc. Report that you've seen X change in the company. Don't worry about reporting it's because I did X. just simply report what you've done and what the change you've seen, and hopefully that makes that job a little easier.
Yeah, I'm not sure charter holders or people in our field are generally inclined to embrace the ambiguity and sort of put the attribution to one side, but it's no, take your point. It's obviously that's a tricky one. We've got
Yeah.
another question here, kind of along similar lines, I guess, just in terms of someone wanting to know what some of the key challenges for asset owners are to sort of become a signatory.
Yeah, so a challenges to become a signatory are hopefully fairly little. We really encourage organisations to become a signatory, and through the monthly events and forums that we have, it's a really great way to learn more about stewardship in the process and build that capacity to be able to produce a stewardship report or include reporting within an existing report that you already release. I would say probably the biggest barrier, if you like, is that reporting and the idea of having to do more, especially in amongst CRD and all of those other fun reporting obligations that I'm sure many of you are involved in. It's a mental barrier that it is further reporting. But I would really emphasize, and typically what we see from signatories is that it's not really new reporting, or at least it shouldn't be new reporting. It's often things that you may be sharing with certain stakeholders, investors, etc., or policies that you have internally. It's about presenting all of these important bits of information that you may not have communicated previously, presenting them together in a way that is, meaningful for those stakeholders. So that reporting is probably the key concern that potential signatories have. But by far and away, we had all signatories who were required to reported last year, and we don't see in practice it being a major barrier, but it is, again, particularly with CRD and things, the idea of further reporting is a bit of a concern.
Got another curly zinger coming here. What have we got? There's a tacit assumption in the presentation that ESG factors impact risk and return characteristics. Is there any evidence that these factors actually impact expected returns beyond an intuitive belief that they must? So I guess just to rephrase that as well, I think you've already talked a bit about that just in terms of when we were talking about the attribution process, that it's not something A caused B, good work, pat yourself on the back. There is obviously a bit of, I hope this is the right outcome. And then within that as well, I think we also talked, it's not necessarily about ESG factors. You can be an advocate, you can do active stewardship for things outside what might be traditional ESG sort of characteristics as well. They are one's a tool, a process for lobbying. The topic can be anything, could be ESG factors, could be not. In terms of the data, it is obviously still out, just in terms of it's pretty hard to identify individual ESG factors and sort of, claim there's some sort of beta of those. And if you invest in that, you get a market return. That doesn't seem to be the case. Or if there is something, those companies are already more highly priced, so the returns sort of fall back to normal. But I think, yeah, well, any other comments on that, Jackson?
Yeah, no, look, I think it's a really fair challenge, and something that each respective organisation ultimately needs to form a position on, right? And it's by no means my or the stewardship codes role to say these are the financially material risks that all organizations face. What we do encourage is going through that process of identifying risks and opportunities, and in my opinion, and it's only my opinion, but often some of those categories do fall into the E category and in the S category, for example. But it's for the organization to go through and identify what are the financially material risks and opportunities, and how are they affecting our portfolio in the long term. And the idea with stewardship is that based on that, you then are actively involved in trying to influence those risks and opportunities, and obviously reduce the size of the risk to maximize that long-term value. I can say, based on what I've seen across reporting and talking to many investors globally, climate change, for example, is by far and away one of the more common E-oriented risks, if you like, that most investors that I speak to see is financially material, and therefore have programs and initiatives in place to influence that risk. On the S side, I would say modern slavery is a really common, probably again the most common S risk that we hear engagement and risk management practices in place for, because those organisations deem it as financially material. So those are just a couple of examples of E and S risks. I think the ESG thing as a phrase gets taken out of context and gets challenging at times. But when you look at individual risks that affect portfolios, many that I speak to say climate change is one, many that I speak to say modern slavery is another, just as a couple of examples.
Yeah, ESG sort of taken on a voice of its own, I guess. Those risks have always been there for companies and they've always been addressed in models. It's sort of just more how it's been dressed up in recent times. So that's, I guess, there is a bit of a change there. Let's have a look at these other questions. I just also mentioned, just before we jump off on that one, um, with the ESG factors, I think it's also important when we're thinking of the investors. You can sort of view it through a couple of lenses, one being whether it's a value base or a values base. So a lot of people come to things with their own particular values and they want to find investments that line up. And they might be looking for asset managers that have signed their various asset codes, and they want to make sure that their investment lines up with that. So that might be pro a lot of these things. Some people also might just do it from a values base, like they might not actually care about a lot of these, but we see people often thinking maybe they don't they don't want to talk about climate change, but they can see the direction of travel for various governments, carbon taxes, various headwinds for companies, and they think actually if I stick in this asset, I'm going to lose money. So just from a dollar value, then you might think, okay, I'm going to take these things seriously. It obviously does affect my portfolio. It does affect, how that company runs. So either lens, you actually do end up needing to take these things into account. Question here we've got as well. Some of your signatories claim that they are leaders in stewardship when they are at best slow followers. Do you think that helps collaboration? I guess, well, I'll open that up for you to start with.
Yeah, it's an interesting question and an interesting framing, I guess, as well. I think to the collaboration point, I do think that's part of the strength of having a body that brings different stakeholders in the sector together, and you will always have some leaders in there and some who are, I think, in many instances, quite openly newer to this, right? And they're being joining this group to lift their practices. And I do think by signing up to the code, it's a really strong indication that stewardship is important to them, and they're willing to create a public document that discloses their activity in this place and creates that transparency and accountability. The collaboration point's a really great one, I think, because one of the best ways to get better is by joining a collaborative engagement, for example, which is often led by an industry leader, and learning what that looks like and learning how they can be involved in that, and presumably wanting to be to be in a similar position in the future. So there's definitely newer, those that are newer to stewardship and those that are more experienced. And I mentioned this morning we had Nico Asset Management that launched in the 50s, for example. So they've got a wealth of experience around them and are openly sharing some of that experience with signatories to support building that capability. And I think that's a part of the key value proposition of having a body like the code that brings these organizations together so they can share their learnings and learn from each other and hopefully lift the market collectively.
Yeah, that's a fair point. I think it's quite good that there's that option for people to sort of come and share. Maybe they've got the same questions, or like you say, people are learning from others. And we're quite lucky that we can have the resources to deliver a 100+ page report. But that's probably not fair on a lot of places that are, like you say, just new. And it's great to have a forum where you can actually say, oh yeah, we've tackled that in different countries. This is how we've dealt with it, and people can learn and sort of up their game. So I don't think you can expect everyone to be quite at the same level in terms of. I'm sure the FMA are there to make sure people aren't stretching the truth too far if you get out of hand, in terms of making sure your products are what they say on the label, particularly in terms of the investment process and that sort of thing. Got another question here. What are the emerging material risk, or is it emerging market risk? I guess it's emerging material risk you would suggest investors should consider.
I think it's been clarified material.
Yeah,
Thank you.
yeah, yeah. Uh,
Um,
there might be a little voice AI going on there, I think. Um,
no,
maybe emerging risks coming into the space, something for people to be aware of.
yeah, definitely. Well, most importantly, and kind of to part of my response for a previous question, is that I really encourage organizations to go through this process and engage with their stakeholders and find out what is the specific relevant risks that are financially material to their portfolio based on the environment around their portfolio and their beneficiaries' beliefs and priorities and things like that. So I do really encourage a bespoke process there. At the same time, can't help but really go past, I think, the emerging conversations and financial materiality that we're seeing around nature, specifically around the world at the moment. There's a number of frameworks now, like Encore and some others, which are specifically designed to demonstrate the financial materiality of nature. I think in many of nature risks, I think in many ways that financial materiality for nature is more tangible and easier to see and understand and respond to than it was with climate, for example. And so my hypothesis is that the adoption or understanding of nature risks and adoption of processes to better manage them is going to ramp up pretty quickly in coming years. Once people get their head around how to understand the data that exists and how to determine the financial materiality of that. I think there's going to be a lot of work in that nature space. Another risk I would observing, but is harder to tackle just now, I think, is kind of the consequences of social inequality and the instability that that creates for economies and for portfolios accordingly. So there's some really challenging longer term risks, I think, that social inequality is contributing to globally. This is not targeted at New Zealand by any means, globally. And it's that's something important for the global capital markets to figure out how they can respond and influence those risks also, because that's going to make stable long-term returns a challenge in the longer term, I think.
Yeah, no, fair enough. We've got another question here. Reporting aside, the important and critical thing is that asset owners are indeed practicing stewardship. Do you feel that asset owners understand enough and have the resources, like talent and tools, to operationalize?
Yeah, good question. I would love to know whether this is coming from a signatory or not, because we've been having a lot of conversations amongst signatories on this topic at the moment, and that's in part off the back of global activity in this space, with a real rise, particularly from the UK asset owners, around the way they monitor and hold to account their asset managers or third parties, because I think there's a growing appreciation that it's one thing for asset owners to have a policy and expectations. It's another thing to make sure that those are consistently implemented by the asset managers and others who are implementing their tools. That's a really developing and rapidly increasingly robust sector or approach that's being worked on in the UK, and it is starting to trickle down into New Zealand. So we're having a number of conversations with New Zealand owners and managers who have external managers, for example, around what does effective oversight and accountability of those third parties look like. You're right, though, in that often the resourcing of owners in New Zealand is much more limited too. But again, I think there are ways to kind of right size the approach given the limited resourcing to make sure that that accountability can be done effectively, the monitoring and accountability. So it's certainly something that's kind of an active conversation that we're having with signatories. And feel free to contact me if you'd like to have a more kind of detailed conversation about this one as well, because happy to share some of those examples from the UK. There's a number of case studies out there now around what that good oversight looks like and operationalizing this and talk about right sizing that for New Zealand too.
Cool. No, it's a very generous offer. Thank you. And that's probably a good place to wrap up. Got no more questions. So obviously the offer's there if people want to get in touch with Jackson on some of those matters further. And thank you for your time, Jackson, and the presentation. And also thank you all the participants. Many thanks.
Thanks, everyone.
Cool. Have a good rest of the day. Catch you guys.